welcome to the Growth Engine Fundamentals video series. And in this episode, we're going to be speaking all about finance. Now, if you think about finance, it's in every aspect of your business, and without it, your business doesn't run. See it very much like the blood that runs through the veins. I'm often asked, what role does the management team play, and what role does the finance play, and a whole host of other questions. And ultimately, here's a great little way and a little sort of analogy that I like to think about it. Whilst the management team is the heartbeat of the business, finance is the blood that runs through the veins. And in this sort of video series, we're going to be speaking in each stage about the growth engine fundamentals, just to set the stage exactly what we mean, and ultimately that really falls back into two things that are very closely related, which are team alignment and making sure that right from the top, the business adopts the inbound methodology throughout the entire business model, not just the marketing area. And we'll then move into the overview of growth engine finance, and we're going to be touching on raising capital, employing capital, managing capital, and distributing capital. And the term capital is finance or money employed, and we'll talk about that. So that could equally say raising finance, employing finance, managing finance, and distributing finance. But for this video series, we're going to be calling it capital. So without further ado, let's move forward. And I said we'd start by sort of setting what I call the fundamentals. And when you're talking about growth engines, and especially around the inbound methodology, we use the inbound flywheel, which is broken up into three specific areas of attract, engage, and delight. And it puts the client at the center of everything that you do. So if you're going to become an inbound business, then the client has to be at the center of everything you do. And don't fall into the trap that thinking that the attract phase is just related to marketing, and the engage phase is where your sales team take over, and then the delight phase is where your customer service team manage and look after them. The clients once they've become customers and purchased. That's not true. The attract, engage, and delight phase is at every single point. So that applies in marketing, it applies in sales, it applies in customer service. So when we talk about growth engine fundamentals, we're going to be making references to the flywheel and ensuring that the client's at the center of everything that we do. Now, it doesn't really matter what type of business that you are. They're really outside of what I call corporate governance and the law and the legislation. So outside of that, which I've left out of this presentation here, that there is only 5 segments or areas of a business. And that doesn't matter if you're online e-commerce, you're in elongated long sale, complicated sales process, you're in B2B, B2C, H to H, doesn't really matter. The 5 really are applicable, and whatever you do within your business is really going to fall into one of these 5 buckets. So let's just take a recap of these. The 5 buckets or 5 areas are finance, operations, people, marketing, and sales. So, you might be sat there thinking, well, where does my manufacturing team or my customer service team fit, or my customer service team who are maybe on refunds, or the ones who are out there doing trade shows and things like that. So I'll cover that on the next slide. But I just really wanted to recap. Growth engine fundamentals put the client at the center of everything that you do, and even when they're just becoming prospects before they're even clients, that attract, engage, delight is applicable throughout the marketing, the sales, the customer service, and every single touch point that you have. So moving this next slide forward, you can see here at the bottom, finance, operations, and people really span out into what we call inbound client services. The marketing is inbound marketing, and the sales is inbound sales. And I just really want to break down the point that I touched on earlier. If you think about it, the finance is what funds and fuels the business. The people is what make it move, the actual execution of it. And that will sort of spread. People will spread into finance, like your purchase ledger clerks, your finance directors. People spread into marketing and marketeers, and obviously salespeople, business development reps, sales managers, field representation, whatever you have titles there. But people always drop into operations. And the way I see operations is everything from the products that you manufacture, the distribution channels that you get your goods to market, whether that's your transport division, your courier division, your customer service team, your research and development team. So that's really where I bundle operations in. And ultimately, if you think about it from a inbound marketing point of view, that's bringing prospects who eventually become customers through inbound sales. And then inbound client services is really the fulfillment or the production or delivering what you've sold. So again, it's just getting familiar with that terminology, right out of the gate. And ultimately, if you think about it from that point of view, if it's not marketing to bring people to the business and nurture and educate them through a process, or it's not sales that is actually, engaging and helping people to buy, then ultimately it's going to fall into fulfillment that we class as inbound client services. So let's get, a little bit of more of a higher line overview on growth engine fundamentals of finance. So once we've employed the capital into the business, how do we best manage it? So I'll just go back there. How do we best manage capital? Because if you just sort of pour it into the area and not manage it, that's not going to get the best return. And often, one of the biggest frustrations from an investor point of view, one of the biggest frustrations from you as a business owner, is where you look back and think, oh, we wasted that money, or we didn't best use it. And then you've got to go back to the banks or your VC, your venture calculation, your angel, and say, look, we got this wrong. Can we have some more money? That begins to be even more expensive. They may not even fund you at all. They may think it's irresponsible. And whilst you will make mistakes, and it's acceptable that you make mistakes, then what we're trying to do is say, hey, you wouldn't, if you've got a heart condition, you're going to put a heart monitor on there, you're going to monitor the beats and things like that. So capital is a resource that is replaceable. It's not like energy or time that's lost, but it can be replaced, but it can be very, very costly, especially if you have to give more equity away or give more security to borrow more capital. So here's a couple of overview areas that I would recommend that you have a firm handle on. And there's no major surprises, but you do need, like you would with your overall business model strategy and your sales and marketing strategy and your people and recruitment strategy and your production regulations and strategy, you would need an accounting strategy and a financial infrastructure to measure that. And with the government making tax digital, and there's such a low cost of running accounting systems these days. You don't have to have, unless you're seriously large business. Most small and growth-focused businesses can run off things like Xero or Intuit, QuickBooks, smaller packages of Sage, although I recommend Xero and QuickBooks. I think they're certainly a fabulous tool at low cost. So you've got to need some type of financial infrastructure system, and somebody internally either to run that, or you can outsource that to a bookkeeper or an accountant. But when managing capital, what we're really looking at is it's not just the cash that we're looking at, it's the assets. Some will depreciate, whether that's straight line or there's a percentage per annum, and also managing liabilities. Because, on the balance sheet that we're going to talk about in a few minutes, there's one side is assets, one side is liabilities, and capital. If you've got money that's required to repay those liabilities, especially if it's a loan or something of that basis, it's having a keen eye on both the assets and the liabilities to manage capital to make sure that it's fluid. Are we investing the right amount of money into the assets? And are we using the right investment vehicle or acquisition vehicle? Is it a cash purchase? Is it a lease? Is it on or off a balance sheet? Is it short-term rental, or are we just going to pay and buy it outright? So that's what think about. What's the best use for assets? And again, so many different permutations around that. Your accountants or your auditor would be a great way, or non-executives are a challenge. And then liabilities, of course, making sure that we can spread those over the right area, meet the requirements so it's not burning into the cash flow too high and things like that. So managing capital in working capital, ultimately, the business is moving. It's a dynamic business. The phone rings. That's a different conversation to the last one. Invoices are being struck and raised and issued out, and then there's a timing before the cash comes into the bank. And even if you're an e-commerce business where you get paid up front, you've still got a delay before the cash hits the bank, because whether you use Stripe or WorldPay or Authorized Debt or any of these e-commerce sites, it could be 3 days, it could be 5 days. A standard Stripe account is 7 days before it hits your bank. So you're going to need working capital to pay all the bills, keep the lights on, and again, whether that's managing an overdraft facility, managing the repayments of a loan, and just cash reserve. If you're fortunate enough to have cash reserves, then keeping that there so you're not burning through that. And that sort of segues and goes into the cash flow liquidity. At any one period of time, you'll see at the bottom of the screen we talk about cash flow statements, and that's really assessing any given period of time. Ultimately, the cash flow liquidity. Do we have enough cash to pay the immediate liabilities before the next tranche of cash comes in, whether that's an invoice payment from a client or such. We talked earlier under the liability section about debt repayment. Often, bad management can result in cash coming in and you not having the right payment structure throughout the month. And I always recommend, even if you'd set up like a Google sheet or an Excel spreadsheet, just put 1 to 31 across the bottom, and then just put when all your money goes out of the bank, all your direct debits, your rent, your telephone bill, your salaries, any major backs payments for suppliers that you have to pay, load those in. And then when you are looking at it, you can see where the cash peaks and troughs are going to be throughout the month. And then if that's a loan repayment, like debt repayment, then ultimately you can make sure these are up there. Often I see when I work with businesses that they don't get the timing of the loan repayment. They get the money in, and if they've invested it, especially a few months down the line, where they're relying on their creditors paying them on time, and the debtors and the creditors, all that type of inflow and outflow of money, where sometimes the loan repayment bounces just for a day because there wasn't enough cash in the bank or it breached the overdraft, and that can send shockwaves through the loan provider. And it can be avoided just by managing capital and the inflow and the outflow. And savings. Just because you've got a cash reserve, it doesn't give you willingness to go and buy everything. I see it also often where entrepreneurs and growth focused people, I've got 20 grand in the bank, I'll buy that new car, or I'll buy that new office, or equipment and furniture, or whatever. And really, a cash, in the bank is not always a reflective or an accurate reflection of how the business is trading. So managing savings is pretty important. And ultimately, sometimes, if you like the bank with a high street bank, HSBC, Barclays, Santander, Lloyds, NatWest, whatever it would be, sometimes it's better to pull that cash reserve out and put it into a different savings company. If you can sign it off for 3 months, 6 months, 9 months, 12 months, sometimes there is external savings companies who will give you it on immediate notice and will pay a higher rate of interest. So managing capital and positive cash balances is a great way to make a little bit extra money and make your money work harder. So once you've managed your capital, it's really going to drop into your profit and loss, which is ultimately by any given period, that day, that week, that month, that quarter, or that year. How is your business trading? How much income versus direct costs, COGS, cost of goods sold, versus the cost of goods bought in to facilitate that. To give you the gross margin, to then look at your overheads or your indirect costs, should I say, to then see if you've made a profit and net profit at the bottom. So profit and loss, that's a great way, and I recommend that if you are running something like Xero, or you're running something like Intuit, Sage, QuickBooks, those type of products, it's not difficult. If you can't do it yourself, ask your bookkeeper or your accountant just to set up a monthly P&L, and then you can log on, look at the dashboard. You can do daily, weekly, monthly, and it's going to give you a real good sort of sense of how your business is performing in real time. The balance sheet, ultimately the book value or net net asset value of the business, with all your assets, less your liability, plus any cash. What's it worth today? And sorry, apologies, not cash, equity at the bottom. So what are your assets minus your liabilities, plus any equity? That's going to give you the balance sheet. What is the book value of the business? And then cash flow. I talked about that earlier when we was mentioning about working capital and cash flow liquidity. It's really at any period in time of, in the next 7 days, how much cash do you need to pay the bills and keep the lights on? What's the forecast going to look like of how much cash we're going to even need to keep the lights on, or what's the cash flow statement, how much we will make or lose. So these are some areas that you should have. I would have firm handles on your cash flow statements on an ongoing basis. Your balance sheet is it a year end? It can be a year end, but monthly and quarterly, just to make sure your solvency and how you're trading. Any profits or losses that you're making is going to get transferred into your balance sheet to increase or decrease that. But get some angles on these, get some firm grips on these, and start to learn to manage your capital a lot better. So if you've got any questions on managing capital, again, I'd be delighted to answer some questions for you on that. You can use the hashtag growth engine on our preferred channel on Twitter, or leave us a comment on the blog below. If you've got some private information you would like to chat, connect with me on LinkedIn. I'd be more than happy to have a chat with you.